Good morning. I'd like to, we do roll call after. I'd like to call the meeting to order.
After the Pledge of Allegiance, I would like to observe a moment of silence for everybody that was affected in the events of the in Clayton last week at the U.S. Steel Coke Works, please. Thank you.
So first, we'll stand if you're able for the pledge. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Walt, could you do roll call, please?
Yes. Corey O'Connor,
Amy Wise here on behalf of Corey O'Connor.
Sarah Morado,
Present.
Frank DeCristofaro,
Present.
Kimberly Joyce,
Here.
Jennifer Liptak,
Here.
Sarah Roca,
Here.
Erica Brustlers.
Present. Are there any public comments?
We have none.
I will give a president's update. On July 10th, 2025, the working group on planned funding and modernization met. There was a discussion finalizing a request for qualifications for a consultant to help lead a process. That was finalized in the following weeks. That was issued about 2 weeks ago. That RFQ is open until September 5th. Okay, and there are copies of it outside by the agendas, and it's also posted on the retirement website. Additionally, I met with Chris and Tim and Walt on the topics of some iNetworks investments that we have. We're expecting they'll come ask for a 2-year renewal, likely in September. We're working to schedule some time with the general partner. Is that? Yes. Yeah, with the general partner of that company. And that concludes my updates.
Thank you. Board approvals. The first will be a motion to approve the board meeting minutes of the June 19th, 2025 board meeting.
Second.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye.
Aye.
Any opposed or abstaining? Motion passes.
Next is a motion to accept the financial statements, which include the pension fund assets, the statement of changes in plan net assets, and the RBAC balance sheet for May and June 2025.
Motion.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye.
Aye.
Any opposed or abstaining? Motion passes.
Next motion is a motion to approve the August invoices totaling $354,540.13.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor?
Aye.
Any opposed or abstaining? Motion passes.
Okay, next motions are for applications. The first will be a motion to ratify the July 2025 applications. There were 5 early voluntary, 14 full retirements, and 1 disability.
Motion.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye. Any opposed or abstaining? Motion passes.
Okay, the next motion is to approve the August 2025 applications. There were 6 early voluntary and 9 full retirements.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye.
Aye.
Any opposed or abstaining? The motion passes.
Next session is the independent medical examiner's opinion for disability application approvals. The first is a ratification from July, and this motion is to approve member 095412 upon the recommendation of 3 designated physicians is totally and permanently disabled from any gainful employment in Allegheny County.
Does anyone want to make a motion?
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. And any opposed or abstaining? Seeing none, the motion passes.
The next is to approve members 103439 upon the recommendation of the 3 designated physicians is totally and permanently disabled from any gainful employment in Allegheny County.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? And seeing none, the motion passes.
Okay,
Oh, next, would you do the report?
Yes.
Is that what you were looking at before? Okay, yes. Next, we'll have the director's report from Walter Schmansky.
thank you. So if you turn to the Director's Report tab in your monthly board books, I'll highlight some areas on the dashboard. First off, retiree payroll is up 4.24% from this time last year. Contributions made are up 6.07%. Contributions refunded are down 13.29%. We have the listing of the active payees and deferred members that are in the plan currently, total of 13,024. If you turn the next page, retirements are up 17.5% as compared to last year. Pension estimates are up, but once again, that's going to be a higher number because of the online estimates. I have capital calls as of the last prior board meeting that were processed were $293,385.82, and I have the office budget as of July 31st, 2025. Are there any questions? No? Okay. So then some board updates. First off, the retirement board staff visited County Police Headquarters and the Airport Police Headquarters. We were able to review benefits, answer questions, run calculations. We had our open house on July 24th from 10 to 2. We had a great turnout. We had roughly 75 employees throughout the day, and there were over 50 participants that attended online in the Gold Room seminar that we had. Staff are currently scheduled to visit Department of Human Services on September 27th at 11 a.m. and EMS on September 30th at 1 and the 31st at 5 a.m. Moving forward after today, Carol will be giving a report every 6 months on the number of participants we've had in online seminars and open seminars. We're also working with the airport to hopefully have the BNY contributions, or their contributions coming to BNY to pay next week, so I'll follow up with them then. As that's completed, we'll work on transitioning the bank account from FNB over to BNY, so that should hopefully be completed before the end of the year. So far, we've had 2 submissions on the RFP for the auditing services, so we extended the date an extra week. So now the expiration on that's August 27th, so hopefully we gain a few more. And that's all I have for this month, unless there are any questions on anything.
No, thank you.
Thank you.
And the assistant manager report from Carol Uminski.
Good afternoon. As Walt mentioned, twice a year I'll be reporting on the education that we do. This one that was presented in the book is from January 2025 through June 2025. You'll see that the monthly wellness education that we do with Duncan Financial through our contracts. You'll see the registered versus the attended. Registered is always a little bit higher. I don't know, we haven't been able to figure out why not everybody that registers participates, but we're trying to get a hold on that so we can increase participation. But they're always well attended. I shouldn't say always, but the noon is more attended than the evenings. But we'd like to offer the evenings because not everybody can do it during the day. And we're also reporting on the financial wellness with the Duncan for individual financial planning. And we're kicking off the Saveology, which we're really excited about. That's an app where you can go on. It takes about 5 minutes to enter some criteria for your investment, your debt, to find out how well you are with a grade. I did it, and I'm happy to say I came up with a A-. So it's just a little snapshot in time of how you're doing, and if your grade isn't exactly what you want it to be, it has a lot of links to how you can improve that grade, whether it's, paying off debt or better investing. And if you want, you can reach out to the team at Duncan for a personalized one-on-one to help you improve your financial outlook as well.
Yeah.
One question. I was concerned about this before. We're offering these services, but I was always concerned about that this one company would then, get business from, or feel like they're in a position where they're starting to work and give an advantage. So I just wanted to state that for the record. I think that Duncan's doing a nice job, but I also want to make sure, I mentioned this before when we brought them on, they're here to give education. I didn't want to create any appearance that the board was endorsing this one company for people to use personally to help with their finances. So that was just a concern. I think I brought this up years ago, so I just wanted to mention that.
We went out for an RFP before we brought Duncan Financial on. They were the only team that met the criteria of being able to educate. We made it perfectly clear that they're not allowed to sell. And we remind them all the time that they're not allowed to sell. This is a free service to anybody who engages with them. So they will, once somebody reaches out to them and they have meetings, maybe some advice, they will never reach out to them for any other products.
Thank you. Thanks for voicing that, Member Liptak.
And I also just wanted to conclude with the on-site meetings. Since 2020, all of our meetings have been Teams meetings, Zoom meetings. We've had a lot of requests that we go back to in person. So our staff loves going out. They love interacting with the employees. So we did that initiative this year. And you can see from the report that we had very well turnouts. The difference between the on-site meetings and the presentations are, the on-site meetings are typically we set up shop. We go a conference table, we have a printer, and we're doing estimates and answering questions. We answer a lot of the same questions, but the presentations are more geared towards new employees, retiring employees, maybe just a general overview and talking about specifics. So I got in a little bit more detail since this is the first report, but if you have any questions, I'd be happy to answer them.
I did have one question around communications with employees when they start working for the county. I know the HR onboarding process moved, I wasn't here then. My understanding is it moved online with COVID, and that they, prior to that, had been in-person meetings and the retirement staff would attend. So if you could speak just a little bit about what that looks like at this point, if you have any direct access to new hires, either in that onboarding or otherwise.
I really like the in-person meetings, but they moved online. We were given 5 or 6 minutes to go over an overview of the retirement, which really isn't enough time. They're taking in so much information. About a year, maybe 2 years ago, they moved from the, I'm going to call it in-person online, to a canned presentation. I am going to reach out to them to update that presentation in the next couple of months. And Walt and I will talk about maybe how to get better interaction with them.
Yeah, and sorry to point at something that's maybe not in the ideal. This is great, the outreach that you all have restarted and getting out to the departments. I know I've heard appreciation from entities outside of the courthouse that you're getting out there and reaching people. So thank you.
Thank you.
Are there any other questions? Let me put my agenda. Next, we will have our solicitor's report from Brian Gabriel. Thank you, Carol.
Right before Brian starts, I just want to make a point. The policy is correct. The whereases are the incorrect draft version, so please ignore those. I'll re-email that out. That's in the book.
All right.
On resolution 2025-1.
So some of the whereases.
For an old draft form, I must have included the wrong file.
Oh, okay.
But the policy itself is correct.
When you, oh, the resolution is worded incorrectly?
I sent out the wrong one being read.
Okay, the policy included that starts on the second side
Yeah.
is correct. So,
The whereas is,
and we're looking, this is,
for Brian's report, but before he gets into it.
I'll let him get into it.
Okay.
And then we'll ask questions at the end. Thank you.
Since we're talking about it, the attachment to the solicitor's report is a draft resolution, and within the draft resolution, there is a draft securities litigation policy and guidelines. So the idea was to circulate this obviously to the board for review, and we could move for formal approval as soon as the next meeting or at a later point if the board requires additional time. The substance of
Right.
the substance of the guidelines are largely to document current or existing practices with securities litigation, when it comes in and how it's handled and how it's presented to the board, when it's presented to the board. There is some additional detail, including a proposed threshold, a loss threshold of $100,000, which isn't, that's not a magic number that has to be the case, but that's at least for purposes of review and discussion, a threshold that's in the policy. So certainly that would be one of the items the board would be encouraged to review.
Okay, and just for folks who, like the board is a large institutional investor, sometimes pursues class action lawsuits, and so this pertains to how we decide which ones we might be a lead plaintiff on. And you may have said that at the beginning, but I was like looking at all my pages. I had one comment from my read of it, and just is that I think we have a capital fund, so I think we should define what specifically that relates to in here. But otherwise, it looks like at this point we just take questions and potentially have it on the agenda to approve next month. Are there any questions or at this point? All right, thank you. What else is in your solicitor's update?
So going in reverse order, the solicitor's report is dated August 14, 2025. One mention outside of the report because of separate reporting over the past several months, the litigation at GD 24-9033, which was the controller's litigation, was discontinued on July 25th. So that matter is now closed. There won't be a need for further reporting or any further activity. Outside of that item and the report itself, I don't have anything specific to the board, but would be happy to answer any questions.
Seeing no questions, thank you very much.
Thank you.
Next, we have our consultants for Mariner Institutional on the topic of investments, Chris Brokaw and Tim Walters.
Thank you. If you go to the tab, Reports Mariner, the first 3 pages of the portfolio are a bit about our firm. I'll just generalize and say it's a proof statement that we are doing some good work. 99% client retention, 99%.
Congratulations.
Yeah, thank you.
I saw the scan code marketing materials on the third page.
Yes, and now we'll get into your portfolio. And if you turn to page 6, a quick comment on the market, and I'll only look at this one page regarding the market, which you see the information in the portfolio, or the information in the report is as of June 30th, so the end of the quarter. And of note, the U.S. equity markets had very strong performance in the first quarter. Beginning of April, there was negative performance, a lot of volatility, and I think at prior meetings we talked about that. Subsequent to mid-April, for the rest of April, May, June, July, and through August, the markets, equity markets were strong. So that's the U.S. The gold bars in the middle are the international markets, and if you look at the international markets performing even better than the U.S., markets. That continues the reversal of a trend. The U.S. equity markets had been outperforming for years, and a portion of that performance is due to currency. Foreign currency strength is supporting those returns. And for example, that 12% MSCI equity return, half of that, 6%, is due to the strength of the foreign currencies. So the background for the portfolio is a strong equity market. If you turn to page 15, this is the asset allocation, and if you recall the way the schedule works, the gray bars are the ranges within your investment policy, and the black lines are the target. So items of note going down from the top of the page are the international equity, non-US equity, towards the top of the range. And a lot of that is due to the very positive performance in recent periods, lifting it up there. Fixed income, a bit behind the target, the third line, and that is, again, due to the relative performance. Equity, a much stronger performer. Real estate is outside of the range, but that is coming down as distributions, and I'll show you on the cash page, distributions come from some of the private investments, and that ended up above the range, you may recall, due to the reclassification of some real estate investments that had been included in private equity. And that probably introduces a good time to talk about the bottom line there. The private equity is below the target, again, due to that reclassification, but also based on discussions that we've had at prior meetings and included in the asset liability analysis that I'll discuss in a few moments. You're in the position now, your liquidity is paramount, so we're looking to lower that target allocation and still meet the goals, the long-term goals of the plan, and that's what you'll see in the asset liability analysis. So what I want to leave with you is there's 3 red triangles, and we're taking action to address all of those items that are outside of the bounds. The liquid policy portfolio is what we use to fund distributions from the plan at this point, and that has decreased over time, and now at 1%. At the next quarterly report, it could very well be gone from the portfolio. Any questions at this time on allocation? So if you turn to page 18, you can see the assets themselves in the portfolio. At the beginning of the quarter, $936 million. At the end of the quarter, $970 million. Net flows, primarily benefit payments, $16 million out of the portfolio, and the return for the quarter, $51 million. Again, as I mentioned, the equity, lots of volatility in the second quarter, but by the end of the quarter, not just recovery from the declines in early April, but significant positive returns. And next item that I wanted to address is the private equity distributions on page, page 20. That's what I have in my notes. I'm sorry. Not page 20. Your private equity funds, 20 of the funds made a distribution in the second quarter. That is my note for 20. So over time, and you can see these cash flows on pages 20, 22, and 23. And the second column of numbers is really where those flows are coming from the private equity portfolio. So I did just want to point out some of them are small. In fact, some of your funds themselves, some of the older funds are $100,000 or even less than $100,000. And some of the funds in total, 23 of the 53 funds are less than $1 million. So you're getting cash. It's just slower than expected and slower than we would want. Any questions on that at this point? Okay, page 31. Page 31 is the performance of the portfolio for the quarter, and on page 31, which you'll see for the quarter, positive performance, almost 5.5%. And if you go down that column for the quarter, you can see U.S. equity was up over 11%, international even higher, similar to what we saw in the market review, up almost 14%. Fixed income a bit over 1%, and the other larger investments, real estate close to flat, private equity as well, relatively flat, and infrastructure 1.3%. The liquid policy portfolio in line with the market, returning 7.8%, and again that is that's being liquidated to fund distributions from the plan. And
I have a question.
Yes.
I thought private equity just did valuations like annually. So help me understand
Right. When there are changes, so oftentimes when there are distributions, you'll see changes in performance in the valuation. So if they sell a company, and for example, let's just say it was $1 million investment, and the fund gets back $3 million, that added return will be a positive return for that period. So you see a lot of flat returns quarter to quarter in private markets when there aren't a lot of transactions, and there haven't been a lot of significant transactions. So it's not just one time a year.
Okay, so is it fair to say it's like a meaningful number? Like quarterly private equity?
Yeah. Well, one, it is a bit delayed, and two, if I can maybe rephrase, is it a meaningful number? When you look at the return relative to the index, and you see a wide variance, that's because the public markets have performed very well. And in your overall policy for the total market, we're using a public index measure, the Russell 2000.
Okay.
So. Is it fair or unfair? I think I would say it's fair, but it's not the whole story. With private equity, there's a lot of details that make it a bit different than the public equity. And on that topic, I did want to talk about a page that is relatively new in the report, and that's page 38. And that may help to get to some questions about the performance of private equity. So on page 38, if you look at the column, so the left-hand side, the column that says private equity composite. Private equity composite, those are the returns for your portfolio. I'm going to focus on the second line below there that says PME plus. and Russell 2000 index. So what we're comparing the private investments to is a public market index. Russell 2000 is small cap. We believe it's appropriate for comparison to private equity. Private equity is small companies. Not publicly traded, but small companies, not all that differentiated from the Russell 2000. The difference between the Russell 2000 and private equity is private equity has the delayed valuations. The valuations often go up when there are distributions, whereas the Russell 2000, all those stocks trade daily. It's a daily index. So what's my point? What I want to introduce to you here is when you look at the 3-year and 5-year numbers, because the returns of private equity are lumpy and also delayed. If you look at 5 years, the return is 11.1%, and if you look at the index is 12.3. So it's not exactly on the index, but it's close. The last 3 years, the public markets have done very, very well, and liquidity in the private markets has not been what it had been in prior years, prior to 2022. Part of it was the higher interest rates. So when you see that minus 5% and versus the public markets at 10%, it's really you could think of it as a bit of a timing issue that all those public investments had good returns 4 years ago and 5 years ago, and now during the time, if you recall, U.S. equity and fixed income was declining. So good returns then, and in the 3 years subsequent, the returns have not been as good as the public markets. So I wanted to point that out because I know that over the last number of years we've had discussions about is the private equity, are they good investments, when are the returns going to show up, when are cash going to show up, when is the cash going to show up. So I hope this provides some additional information and maybe also helps answer the question of what's fair. This is I believe this is fair as well. It's just another way to look at it.
Thank you.
Thank you. So, on the topic of new pages, and I won't bore you with all of them, but I did want to at least address what the data is on the 53 pages on the private equity. I know that the chair, the treasurer, had a question about some of the pages. And so just to pull out a couple of examples, and it will also speak to why we're waiting for cash from these private investments. If you turn to page 92, this is an example, private equity fund, Blackstone, tactical opportunities. And the way to interpret these pages is the top portion of it is a description of the investment fund itself. One of the important items there is vintage year. So 2012, if you look at the top there. So this was an investment the board approved, capital was called, and when you look at the chart, that cash flow analysis, the green bars is cash that the fund gave out cumulative over time. So in 2013 and 14, the fund distributed close to $2 million. And then contributed close to $2 million. And then the gray bars are the distributions, the cash that you're receiving back from the investment. And that's cumulative as well. And you see how over time, that gray bar, that stair step goes up. the fund receives the money back. And that's also a reason why you still have 57 investments, because this isn't like an equity fund where you give the money, they keep it forever until you ask for it back. But the money cycles through, and the blue line that you see on the chart is the current value. So right now, this fund from back in 2012 is worth $218,000 after it's distributed back to the fund $2.5 million. And these are, I'm looking at the bottom of the page on the left-hand side.
I think you might have said the remaining capital commitment number when you mentioned the market value number.
Oh, I'm sorry, I did. Apologies. 62,000 is the current value. Thank you. Yes. So again, I'm not going to go through everyone, but I just wanted to point out an example and show how the fund distributed money and the fund made the commitments and received the distributions back. And this time period also started in 2012 and we're in 2025 and it's near the end.
Yes, please.
Great, thank you. So I noticed as part of the information that you provide us is the management fees, and they vary widely depending on where the money is. Is there an opportunity in this analysis to, instead of saying like this, for example, on page 92, that one's long, I'm not going to read it, but the one above it is 1.75% of assets, some no longer charge management fees, others are capped at $1 million. Is there a way to synthesize that and give us a picture of the management fees that have been paid over the lifetime of our money being invested in particular private equity funds?
Yes. The answer is yes, but I don't think it's a snap the finger and we run one single report. I believe it would include going back and getting audited financial information, so that way it's not just the estimate of what the management fee is, but also what the preferred return is, if they're triggering any sort of carry or any of the complicated ways that they make money off of your success within the fund. We would have to do that through the audited financials. So I believe the answer is yes. Let us get back to the drawing board and see what we can come up with for a cumulative of what the aggregate fees paid to each of these private strategies were since inception.
Great, thank you.
And I'll go back and listen to this online so we get it right.
And as a follow-up to that, is my understanding correct that the return rates that we see, they're net of everything?
Yes.
Okay. Thank you.
That is correct. And while Tim is talking about auditing and details, I just want to make a quick comment about the fee schedule that is at the back of the report. And what you'll notice is that I'm sorry. This is really the fee analysis starts on page 141 and goes through page 144. The main I think generalization to take is when you look at pages 143 and 144, those are the ones that have the private equity investments on them, and the private equity investments are the investments that are the most expensive. So we can get the details, but just know generally these funds that are in the process of distributing, those are the most expensive. And when you see the fee that says zero currently, that's because they're so old that they've reached a point generally 12 years when they're supposed to already have all the money back to you, and then they stop collecting fees. But those are the most expensive. On the flip side, on pages 141 and 142, you'll see the least expensive investments are the State Street S&P 500 Index Fund and State Street Acqui ex-US. And those funds are passive investments. So those are you get the market return, no more, no less, and they're very cheap. So I just wanted to make a quick comment on that.
And just a follow-up question, pretty rudimentary. When we're seeing the returns from our private equity portfolio, is that a net picture? Or is it the fees still need to be taken out of that?
That's net.
Okay.
Yeah.
Thank you for clarifying.
And I know we had talked about this recently. Like on the ones where it says 2% of assets, that's an annual fee.
Yes.
On the value, on the market value of the situation. That happens during the original time period of, like, the original call, what's the original contract period?
Yes.
And so once it's past that original period and the automatic extension and the enter period where they're not charging this annual fee, generally. Is that a fair description?
Well, throwing in the word generally is an important part of that, because remember, as opposed to your public market investments where with most of your investments you have the most favored nation clause, so you get the best fee of all of their clients, and also some of them are funds that have a fixed schedule. After that 12-year period, after the generally that 12-year period, then it becomes more of a discussion. And so each one, generally, the fees are diminished or else go away completely. But I can't say specifically. Okay.
That's fair. Thank you.
Thank you.
Were there any questions? All right, keep at it.
Okay. Yes. Tim wants me to hurry up, but I did want to just say one more thing regarding page 92. Just to get the whole private equity, to try to get the whole private equity picture. On page 92, you see on the left, the second to the last number says inception IRR. And that number is the rate of return. So that's you can say that this investment, this Blackstone Tactical Opportunities Fund, over its lifetime, returned annually 6.4%. And that is, relative to the public markets over that time period, not quite at the level of public markets. A last item that I want to point to is the importance of the timing of these cash flows. So the longer it takes, the lower your return. So if you look at this, you have 6.4% return, and then this is my last thing, and then I'll go to asset liability. Page 94. If you look at page 94, different investment, slightly different time period. This is from 2014. And if you look at the bottom right, what you'll notice is significant positive cash flows that happen relatively earlier, and the inception IRR on the left is 24%. So you have 6%, 24%, relatively same time period, and that is really driven by the timing of when you get your cash back. So that's my last comment on this report. I'll be happy to answer any questions. Okay. Asset liability. So after, I guess it was the last meeting, or two meetings ago, when the board established the 7% assumed rate of return, we wanted to revisit this asset liability analysis. I think we presented the last one maybe a year ago, around this time in 2024. And if you turn to page 4, I think the important item here is to show that we were looking at the expected return on assets of 7%. If you move forward, page 8 is really a summary of the data, and this is an analysis that we did coordinating with Acrashore to get the latest actuarial data. And this is a summary of the data that was included in their report. On page 8,
We're in the asset liability tab, ALM tab.
Thank you. So this is just to say that the data that we have is from the actuary that we use for the analysis. Turning the page 10 is a picture of the assumptions for the various asset class returns that are in the portfolio, the returns and the expected returns and the expected risk. And you see items with higher expected returns usually have a higher expected risk. So page 12 is your current portfolio. And page 13 shows the current allocation and also several other mixes that we analyzed. And the main points with mix 1 and 2 is they, in the modeling, get 7% return. And the items of note, and it's visually, it's probably easy to see on the right-hand of the page. You see in mixes 1 and 2, the blue bond section is...
Are we on page 12 or 13?
Page 13. Thank you. On mix 1 and 2, on page 13, the bonds are a bit bigger of an allocation. And the alternatives are smaller. And what we did, we targeted 7%, and we said for mix 1, private equity was allowed to be included in the mix, and for mix 2, we got rid of private equity as an allocation completely. So these are more like theoretical mixes just to show you how you could get 7%. So you could get 7% with up to 48% in bonds if you included private equity, and 44% in bonds if you excluded private equity. Now, again, these are really probably you can think of it as the lowest risk portfolio for that 7% return. And I wanted to show them as examples. What mix 3 does is really incorporate the reality that's in your portfolio. And the main item that I want to point to in mix 3 is the 9% in private equity. Again, based on past discussions, private equity, at this point, there are not going to be any more commitments into private equity. The cash flows out will decrease the private equity allocation. From the earlier page in the performance report, you saw that we were outside of what the policy says for the range. So we are recommending this mix 3 to be the investment policy statement, to be the target for the portfolio. So where does that 11% that was in private equity go to? 7% goes to public equity, U.S. stocks, and 4% goes to the core bond portfolio. So that, in summary, is our recommendation, and we will come back with a draft investment policy that includes those changes. But the recommendation, again, really focuses on the fact that we're not making more allocations to private equity and seeks to retain the ability of the portfolio to get the returns required to support the plan without too much risk.
I'll go. Does anyone else have any questions? So just to clarify, right, because we're,
Yes.
what we actually have is not one of these columns, right? We've got a target that we're off from in a couple significant ways. And that was our starting point.
The starting point is the target.
And then this first column is, mix one is, mix two sounded very like your low risk one.
Well, they both mix 1 and 2 get you to 7%.
Right. So the follow-up question I'm always taught to ask when somebody tells me what percent they're going to get at is like the variance. Is that what I try to ask for? Like what's the...
Yeah, that's the median. Okay. Yeah, so that's the 50th percentile.
Yeah.
So yes,
so one of those is more risky than the other? Or no?
The main difference is really whether or not to include private equity. That's the primary difference between those. In your policy, whether or not to have an allocation to private equity to get you to 7%. So the direct answer to your question regarding risk is on page 17.
And then in the Okay, so so there's a black one,
Yeah.
black circle, that's mix three?
That is the target. So the black circle is where you are now. And you can, the way you interpret this chart is there's more risk to the right. So when you move left, there's less risk. And when you move up, there's more return. So you see the two mix 1 and 2, which again can get you to 7%.
And mix one's like the dark gray. I didn't even see the first one. Just this report.
So
that's furthest to the left.
Yeah. Mix one is a little bit less risky. That includes again 5% private equity. The difference between those two is 5% private equity versus 5% going to the public market. So what the modeling is showing is private equity in this case, when you look at those two, provides a better risk-adjusted return at 5% in the portfolio than the portfolio that doesn't have any private equity. Where you are now, and where you are now is something that you can't really have because you're not, it's my understanding that given the liquidity issues that there are no more, not going to be any more private equity commitments, at least for a couple of years. At that point, the simple reality is right now, you're heading towards that 9% or lower private equity allocation if you don't make any additional commitments. So where you are currently does have the highest expected return, 20% private equity, but the mix 3, which is the lighter colored one, a bit below it and a bit to the left, has that 9% allocation to private equity, which again is the reality of the portfolio. And it does have a bit less risk.
And we're at 12% about private equity right now?
Right at the moment, yeah, I believe.
Do you have a feeling for when we're going to hit 9%?
Well,
That's all the mystery of how much they pay out.
Right. It's the mystery of how much they pay out and how much growth there is in the rest of the portfolio. And while they are moving targets, what I will say is private equity in the quarter had 3%. I'm sorry, 3 million come out of the portfolio, and year to date, it's about 4 million. So with a portfolio of 110 million, if 10 to 20 million comes out over the course of the year, that's 1 or 2% decline in a year.
Okay. So we could be down at 9 in 2 to 3 years. I know you can't.
Yes.
And
the other part of that is the function of the market. The last 2 years have been really awful for the distributions from private equity. Your fund itself in the years prior to that, you were receiving over 20 million, and I believe in 2021 it was over 30 million in distributions from the private equity portfolio. So while I can't promise, just based on what you have now, the expectation is yes, in a year or two, could very well be at that 9%, and absent additional commitments, be heading to an even lower number.
So your recommended is largely based on this private equity constraint. Is that
Yes.
Okay.
Yeah. That's the primary driver.
Lowering your actual assumption to 7%.
Yeah. And it is. And does this sort of assume we have like average private equity, or does this reflect like the reality of our private equity?
This modeling uses the assumptions on page 10.
Did the actuary say that?
It's assuming you have average private equity, the median middle point of private equity. It's not assuming that you have exceptional or worse, but for modeling purposes, we have to assume for every asset class, you're right down the middle.
And so if someone thought we had private equity that was less than average, would we find ourselves that we're just at a lower return and a sort of unknown risk difference? Would that kind of be the way the little circle would move?
Yes, it could be a lower expected return. In an odd way, it might be lower return and also lower risk. Some of the investments that you have within the private equity portfolio are actually not long-term. You would expect them to have lower than private equity returns, but also lower volatility.
Okay. Thank you. Yeah.
Keep saying the private equity. Yes.
Thank you.
The private equity constraint, is that constraint related to our cash flow issues?
Yes.
Okay, I just wanted to clarify that, because when you said it, it sounded like we were saying don't ever invest private equity again. So it's related to our cash flow issues.
Yes, absolutely. And yeah.
I just wanted to clarify that. Okay, so because of our cash flow issues, investing in private equity is probably in the best interest because of our need for cash. So I just wanted to put that on the record.
Yes.
Secondarily, when you referred back to the targets, mix 3 was the anticipated return for mix 3. You anticipated 7% for 1 and 2 mix.
Right. That's 7.5% arithmetic return. Arithmetic return.
Me neither.
Wait, 7.5%.
Return.
Oh, so it's better. It's better than 7%.
Yes.
And just to clarify my comment about constraint.
Oh, no, he meant it.
Okay.
He said constraint, that's why I just want to clarify. It seems to be more about cash flow and where we're at in our position to continue to meet our obligations, not about policy of the board. I just wanted to clarify that. That's right?
Yes, and so based on the actuarial discussion, we feel that it's prudent not to make any additional commitments to private equity when the private equity is a 10-year contractual plus potentially two, so let's call it 12 years at their discretion. 2025 plus 12 is 2037. So we think that it's prudent at this point to not make a 12-year commitment.
Thank you, that's very helpful, I appreciate it.
Thank you.
Are there any other questions? Oh, I've got a question. Off the floor.
Now, Chris, the draft statement is in the book after your report.
Oh, great.
Yeah, the statement of investment policy, the draft. It's after page 145 of your first report.
Oh, okay. Yeah, so this is back to the tab. I'm not going to drag you through it. Essentially, it is the document, the IPS, that would reflect those new allocations for the mixed three that I discussed.
And this is the back of the reports Mariner section, so right before the ALM section.
That is correct. Yes.
I have another question. Will this new draft target eliminate any other specific funds from our portfolio?
No, it doesn't. The policy itself doesn't eliminate any funds from the portfolio.
The reason I'm asking is it does create an environment where we'd say, okay, now we intentionally have to get rid of, we have to reduce private equity, but now this category is going away.
No.
Okay.
No. The funds, and I know we've over the years had many discussions about the number of funds in the portfolio. In the report, when I talked about the number of funds that were under $100,000, those are at the very end of their life, and those funds will exit the portfolio. So the IPS, page 5 is really the only place where there are changes, and those target percentages on page 5 at the top for the benchmark, as well as the bottom middle of the page for the asset allocation. Those reflect the percentages in the mixed three from the asset liability. And again, the main change is moving from 11% from private equity to U.S. equity and core fixed income.
Okay, thank you.
All right, great, thank you.
Are there any other business or new items? Did you want the microphone back? No, you're good.
No. Is this me or you?
I could do it.
Sorry, I missed
Yeah,
that.
it's a board approval. It's a motion to approve the updated agreement with FNB Investment Advisors, and Chris can explain that.
So, but the bottom line is it's an internal reorganization. So you have an investment with FNB. It's about $3 million in your portfolio. It's a fixed income investment, and due to some internal reorganization over there, the management is moving from one department to another. And let me clarify. The same people are managing it. The corporate tree is changing, and they're reporting to someone else. So because of that, they need a new investment management agreement. But the management itself is staying the same.
And is this pile of investments related to like one of our emerging managers?
Yes, it is an emerging manager, and it's on a prior page. We have the checklist. It is green, so it's performing.
Do I have a motion to approve this?
Second.
We've got a motion and a second. Is there any discussion? Seeing no discussion, all in favor of approving this FNB motion, please say aye. Aye. Any opposed or abstaining? Seeing none, the motion passes. Thank you. Now I think we're at the end of the meeting. Is there any new business? All right, we'll our next meeting will be September 18th here at